Imagine this for a second. One single company touching the financial lives of about 100 million people around the world. We're talking TurboTax, QuickBooks, Credit Karma, Mailchimp. It's kind of a silent giant in fintech, isn't it? Really orchestrating things behind the scenes for millions of us. Welcome to our deep dive into Intuit Inc., ticker INTU. Today, our mission really is to pull back the curtain a bit. Look at their recent financials, their strategy, what makes them tick as this, financial tech powerhouse. We're aiming for those aha moments, helping you understand what Intuit's doing, but maybe more importantly, why it matters for where they're headed, their market position, how you might think about them as an investment, all without getting totally swamped in data. And our dive today, it's built on some pretty solid sources. We've got Intuit's official numbers right from their August 21, 2025 press release that covers fiscal year 25 and Q4. We're also digging into their Q1 FY25 deep dive for a quarterly snapshot. And to give it some context, we'll look at a comparison with New Hood Holdings and this really interesting piece on Intuit's customer obsession playbook. So yeah, get ready. There's definitely more to Intuit than just doing your taxes once a year.
You really hit it calling them a silent giant. I mean, their stuff is just woven into the fabric of so many lives, so many small businesses. People almost take it for granted. But this dive, I think, will show just how deliberate, how strategic that presence really is.
Yeah, that should be fascinating. So let's unpack how this Titan actually got started. Let's kick off with Intuit, the global financial technology ecosystem at a glance. I mean, they weren't always this huge, right? Founded back in '83, Scott Cook, Tom Prolex, headquarters in Mountain View, California. And their vision, right from the start, was pretty ambitious, to be the global financial tech platform that powers prosperity. They really seem to believe everyone deserves a shot at prospering. And they've built this massive machine trying to make that happen.
And that mission, powering prosperity, it's not just, a nice slogan. It really shapes everything. It means taking complex financial stuff and making it simple, making it accessible for people, for small businesses that maybe don't have like a dedicated finance person, and hitting that 100 million customer mark globally. That shows their execution on that vision over, well, decades now, had been pretty impactful.
It definitely sounds comprehensive. And when you look at their product lineup, it's kind of staggering. The big ones, everyone knows. TurboTax, QuickBooks, Credit Karma, Mailchimp. But they're not stopping there, are they? They're pushing into things like Intuit Assist, these AI-powered tools.
The AI co-pilot idea, yeah.
Exactly. And the Intuit Enterprise Suite for bigger, more complex businesses. Plus, they've got dedicated platforms, for accountants, for educators, for enterprise. Shows they're tailoring things. And there's all the support, the community forums, specialized blogs like the Tax Pro Center. Oh, and this was interesting mention of the Intuit Dome, like an actual arena, reflecting maybe broader engagement.
Yeah, the Intuit Dome thing. It's interesting. It's not a financial product, obviously, but it's smart. It's a strategic investment in community, in brand presence. Think about it. For a company handling super sensitive financial data, building that trust, that familiarity through something visible, positive in the community, that can subtly build confidence, loyalty. Those are huge assets.
That's a clever way to look at it, building trust beyond just the software. But yeah, they're not alone out there. Competition's fierce. H&R Block and Tax, Xero, Sage Group and Accounting. So the big question is, what makes Intuit stand out here? How do they keep their edge against these guys?
Well, it's fascinating because it's not just about having the most features or the lowest price, though they compete there too. It really boils down to, I think, two main things that work together. First, that customer obsession we mentioned, we'll get into it more, but they build stuff that solves real, often unspoken frustrations. Makes their tools feel essential, not just, nice to have.
Indispensable, right?
Exactly. And second, they've built this powerful, interconnected ecosystem. Once you're running your business on QuickBooks, maybe adding payroll, payments, Mailchimp for marketing, the hassle, the cost, both practical and just mental, of switching everything, it gets really high.
Ah, the switching costs.
Precisely. This ecosystem approach, it creates stickiness. It lets them capture more of a customer's whole financial life, not just sell one-off products. They're offering these platforms that become central, really locking in their market position.
That makes total sense, building that network effect, making it sticky. And this ecosystem idea, it's clearly not just talk. It seems to be driving real financial results. So let's dig into those numbers. How is this vision playing out in fiscal year 2025? This brings us to fiscal year 2025 performance, a year of accelerated growth. Okay, full fiscal year ending July 31st, 2025. The numbers look, well, Pretty impressive. Total revenue climbed to $18.831 billion. That's a solid 16% jump from FY24. And their combined platform revenue that bundles the main online stuff. GBS online ecosystem, TurboTax online, Credit Karma that grew 19% to $14.9 billion.
Yeah, those are definitely strong top-line numbers, shows healthy demand across the board. And that 19% growth in the combined platform, that's really key. It shows that interconnected ecosystem strategy isn't just theory, it's actively driving revenue. It's working.
Okay, now profitability. And here's where we hit the GAAP versus non-GAAP thing, which you always see with tech companies. Their standard GAAP operating income, it jumped 36%, which is huge, $4.923 billion. But their non-GAAP operating income also saw good growth, up 18% to $7.572 billion. Similar story for earnings per share, GAAP EPS up 31% to $13.67, non-GAAP EPS up 19% to $20.15.
Right, this is super important if you want to understand what's really going on. GAAP, generally accepted accounting principles. Those are the official rules everyone has to follow. Gives you a consistent baseline.
The official scorecard.
Exactly. But non-GAAP figures, they're adjusted by management. They typically pull out certain costs they feel don't reflect the core day-to-day business performance. For Intuit, that often means things like amortization of intangibles from big acquisitions like Credit Karma, Mailchimp, also stuff like restructuring charges, stock-based compensation expense, things that aren't necessarily part of the regular operations.
Okay, so if GAAP is the official rulebook, what's the actual value of looking at the non-GAAP numbers? Why bother?
Well, the idea behind non-GAAP is to give investors a clearer picture of the underlying ongoing operational strength. Management uses these numbers internally, too, for planning, because they strip out things that might, distort the view of core business health. Expenses that are real, yes, but maybe aren't happening every quarter, or don't directly tie to selling more QuickBooks, for instance. So for Intuit, that GAAP operating income jumping 36%, fantastic, shows big profit growth. But the non-GAAP number growing 18% gives you a sense of the more stable, recurring earnings power. Consistent, strong growth without the noise of those specific items. You really need both. GAAP for the complete compliant picture, non-GAAP for assessing that sustainable business momentum, the real earnings engine.
That helps a lot, cutting through the jargon. And the leadership commentary, it echoes that positive vibe. CEO Sasan Goodarzi called fiscal 25 exceptional, driven by AI agents and human experts. CFO Sandeep Aujla pointed to outstanding execution. Sounds like a pretty confident team over there.
Definitely. And notice the emphasis on AI and human experts. That's key to their strategy. It's not just tech. It's combining AI efficiency with human judgment. Empathy, especially for complex stuff like taxes or business advice. That hybrid approach, that seems to be a real differentiator for them.
Okay, let's zoom into the shorter term. Fourth quarter, FY25, ending July 31, also looks pretty strong. Total revenue up 20% to $3.831 billion. Nice jump from Q4 last year. Profitability-wise, GAAP operating income swung back to a profit $339 million income versus a $151 million loss in Q4 24. That's a big turnaround.
Yeah, that's significant.
Non-GAAP operating income up a hefty 39% to $1.016 billion, and EPS GAAP was 1.35, way better than the loss last year. Non-GAAP diluted EPS jumped 38% to $2.75. Solid quarter.
That swing from a GAAP operating loss to income is really notable. It points to not just revenue growth, but maybe better cost control, better efficiency kicking in during that quarter. Suggests maybe some of those earlier charges are rolling off or their investments are just yielding more now.
Right. But while the full year in Q4 looked great, if we quickly look back at Q1 of FY25, the one ending October 31, 2024, it adds a bit of nuance. It kind of reminds us how even a giant like Intuit can see bumps from one-off things and why that non-GAAP view matters. Q1 revenue was $3.3 billion, up 10% year over year. Still good, but look here. GAAP operating income actually dipped 12% to $271 million. Why? Restructuring charges, investment losses?
All those one-time items.
Exactly. But non-GAAP operating income was much steadier, $953 million, just slightly down. Same with EPS. GAAP fell 18%, non-GAAP just edged up 1%. So that comparison really highlights how those specific events can hit the GAAP numbers, right? Need that broader view.
Perfectly illustrates it. That Q1 example shows why non-GAAP is used. Those restructuring hits, investment losses, they were real costs hitting the GAAP bottom line, but they didn't necessarily reflect how the core QuickBooks or TurboTax engines were running day to day. The steadier non-GAAP figures suggest the underlying business was performing more consistently, even if the official GAAP results look weaker because of those, temporary factors. It's about separating the engine's performance from things that can just muddy the water short term.
Okay, this next part should be really interesting. Let's break down how these big numbers actually happen across Intuit's key business segments and their big strategic moves. Let's start with the Global Business Solutions Group, GBS. This thing is a monster engine for them. Full year FY25 revenue for GBS, $11.1 billion, up 16%.
Wow.
Their online ecosystem revenue, that's the key metric for their connected services, grew 20% for the year, 21% in Q4, hit $8.3 billion. And check this out. If you pull Mailchimp out of the mix, GBS revenue grew even faster, 18% for the year. Online ecosystem revenue jumped 25%.
Yeah, that acceleration without Mailchimp tells you the core QuickBooks Online and those related services are just flying. Mailchimp being newer and still integrating, it's clearly on a different track right now, pulling the overall GBS average down a bit. Really highlights the strength of their established small business software.
Digging into that core, QuickBooks Online accounting revenue, up 22% for the year, 23% in Q4. They said growth drivers were higher prices, more customers, and a favorable mix shift. Okay, what does mix shift usually mean in software, and why is that a good sign?
Right, mix shift is a great sign here. It usually means customers are moving up the value chain. They're maybe upgrading from a basic QuickBooks plan to, say, QBO Advanced, which has more bells and whistles, more automation, or they're adding more services, integrated payroll, payments, fancy reporting tools onto their existing subscription.
Ah, so getting more revenue from existing customers.
Exactly.
Yeah.
It's positive because it shows Intuit isn't just finding new customers. They're getting their current ones to spend more because they see value in the higher tier stuff. It shows the products are sticky, the upgrades are appealing, and they can successfully upsell within that ecosystem. That leads to higher average revenue per customer, or ARPC. It's a really key lever for profitable, sustainable growth.
So not just more customers, but better customers in a sense, more valuable ones. Does that ever risk leaving behind the really small guys, the ones who just need the basics and don't want to upgrade?
It's a fair point. It's definitely a balancing act. I mean, they do still offer those entry-level plans. The goal isn't really to push people out. It's more about creating a smooth path, right? Start simple. And as your business grows, the tools grow with you seamlessly. The fact that the mix is shifting upwards suggests a lot of their customers are finding value in those upgrades. It validates their strategy of building scalable solutions.
Got it. Powerful lever. Now, online services, that's payments, payroll, capital, grew 19% for the year in Q4. Again, excluding Mailchimp, this segment jumped 29% for both periods. Money services, payments, capital, bill pay, and payroll were the big drivers. Total online payment volume in Q4 was up 18%. Okay, let's talk Mailchimp. Revenue was slightly down in Q4, but Intuit says they're focused on integration, expected to be growing double digits by the end of fiscal 26. We know integrating big acquisitions is tough. What's the long-term plan for Mailchimp inside Intuit, especially this all-in-one business platform idea for marketing? What hurdles might they be facing?
Yeah, the Mailchimp vision is pretty clear, and it's ambitious. It's really about completing that all-in-one picture for small and mid-sized businesses. Intuit gets that marketing is crucial, but also often a huge pain point, super time-consuming, just like accounting or payroll can be. So by weaving Mailchimp tightly with QuickBooks, they want data to flow seamlessly between finance and marketing. Imagine QuickBooks data helping target marketing campaigns better, understanding customers more deeply. It helps businesses grow by unifying things that used to be totally separate. The long game is predicting and solving those marketing headaches before they become big problems, making Intuit the default platform for basically everything a business needs. That slight dip in Mailchimp revenue probably shows they're prioritizing that deep integration, getting the tech right, maybe repositioning it over just chasing short-term subscriber numbers. Integration hurdles, oh yeah, they can be massive. Merging different tech stacks, different company cultures, aligning sales teams, making sure data security is locked down across platforms, moving customers over smoothly.
Sounds complicated.
It is, and it takes time and resources, which can definitely impact revenue temporarily while they focus on getting that integration right. But clearly, they see the strategic prize, that fully integrated platform, as worth the short-term bumps.
Makes sense. The ecosystem play, making the whole bigger than the parts. And speaking of bigger prizes, let's shift to their mid-market expansion, a key growth frontier. They're targeting businesses doing $2.5 million to $100 million in annual revenue now. That's an $89 billion total addressable market, or TAM, they say, and the pain point they're hitting. Businesses being over-digitized, too many apps, data stuck everywhere, wasting time and money trying to connect it all.
Yeah, we hear that a lot.
Intuit's answer is their all-in-one platform, QuickBooks Online Advanced, the Intuit Enterprise Suite, IES, trying to consolidate those tech stacks, automate the complex stuff.
This is a really big strategic shift. Intuit's bread and butter has always been individuals and very small businesses, moving hard into the mid-market. That means targeting bigger companies with more complex needs, often with dedicated accounting teams, needing specialized tools. It's logical, though. Small businesses grow into the mid-market, right? Intuit wants to keep them, grow with them, not lose them to other enterprise software players.
And they're really leaning into AI for this mid-market push. Q4 releases for IES included better multi-entity stuff, AI-driven setup, cutting manual work by like 60%, better PPI views. Plus, they launched AI agents in IES for accounting, payments, finance, project management, automating tasks from hours to minutes. There was even a Forrester study estimating almost 300% ROI over 3 years for IES users.
Wow, 300%. That's huge.
Yeah, and new build IES customers nearly doubled from Q3 to Q4, helped by partnerships with forward-thinking accounting firms. So this focus on mid-market AI automation, it feels central to their future. How big a deal is this shift away from their traditional base? What does it say about their ambition? Does it risk maybe stretching them too thin or running into tougher competition?
Oh, it signals huge ambition. It's a fundamental expansion, not just a tweak. Intuit mastered simplifying finance for the little guy, right?
Yeah.
Now they're taking those same ideas, simplicity, automation, boosting them with serious AI, and aiming them at much bigger, more complex business problems at that 300% ROI figure. That's powerful validation that these solutions are delivering real, tangible value. Now, risks. Yeah, the mid-market's more crowded, more competitive. Established players are there. But Intuit's advantage is that proven ability to simplify, plus their massive data advantage. Their all-in-one platform, especially with AI tying it together, directly hits that over-digitized pain point you mentioned. This shift shows Intuit sees major long-term growth here, leveraging their core strengths in a new, high-value segment. They want to be indispensable as businesses scale up.
So capture them early, keep them as they grow.
Exactly. Capture more of their total spend over their lifetime. That doubling of new IES customers, that's a strong early sign their bet is paying off.
Okay, huge strategic play there. Let's switch gears to the consumer and pro-tax groups. Consumer group full year FY25 revenue, $4.9 billion, up a nice 10%. Now here's where it gets really interesting. TurboTax Live, that's their assisted tax offering with human help. It was a breakthrough. Revenue grew an incredible 47% for the year, hit $2.0 billion. That's 41% of the entire consumer group revenue now.
47% growth. That's massive acceleration.
Yeah, and customer growth accelerated to 24%. How are they using data, AI, and human intelligence to just crush it in assisted tax like this, especially when their overall TurboTax units actually went down slightly?
This is like the poster child for their AI expert platform strategy working perfectly. Brilliant, really. Okay, so overall TurboTax units dipped a bit, but critically, the paying online units, those actually grew 6%. And why did they grow? Because Intuit gained share specifically with customers who file more complex returns, the ones with higher average revenue per return, or ARPR.
Ah, higher value filers.
Exactly. What Intuit's doing is strategically focusing on people who value and will pay for help with more complex taxes. TurboTax Live connects these filers with human experts, but those experts are armed with Intuit's AI tools. The AI makes the experts super efficient. They can handle more clients, give better, more personalized advice faster, so fewer total filings maybe, but the filings they kept in gains were much more profitable. They deliberately gained share in that high-value, high ARPR segment.
So it's like quality over quantity in a way, at least for the total unit count. The data shows this. Total U.S. TurboTax units down 2% overall. Both online and desktop dipped slightly. But like you said, the paying online units grew 6%, driven by winning those higher ARPR filers. And this was offset, they say, by yielding share with lower ARPR customers. What's the strategy behind letting those lower value customers go? Seems deliberate.
Oh, absolutely deliberate. It's a very smart, profit-focused strategy. Shows they really understand their market segments. Instead of fighting for every single tax filer, which can just become a race to the bottom on price, especially for simple returns.
Right, the free file market.
Exactly. Intuit is focusing its firepower on customers who need and will pay for more, help the assisted services. These folks usually have more complex situations, generate higher fees, and have greater lifetime value to Intuit. By yielding share at the low end, they're basically saying, okay, if you just need a free, super basic filing, maybe we're not for you anymore. They let those go, while doubling down on serving and capturing that higher value segment. Drives more revenue, more profit, strengthens their hold on the premium end of tax prep. It's a clear sign they're optimizing for profit and value per customer, not just raw volume market share.
That is savvy, really understanding segmentation. The ProTax group, serving the professionals, also grew revenue 4% to $621 million. Okay, now, Credit Karma. Continued momentum here. Full year FY25 revenue, $2.3 billion, up 32%. Q4 revenue, $649 million, up 34%.
Strong acceleration in Q4 there.
Yeah, driven by personal loans, credit cards, auto insurance, and get this, the Credit Karma integration with TurboTax actually drove a point of tax revenue growth. Nice synergy.
Credit Karma's performance is really solid, especially that Q4 jump. Shows they're competing well in that crowded personal finance space. And that TurboTax integration, that's absolutely critical. It lets Intuit link your financial profile, your credit, your debts directly with your tax situation, creates a much more holistic view of the customer, right? And potentially more ways to offer relevant products or services, keeping you inside the Intuit world for more of your financial life. That cross-pollination is a huge growth engine.
And this focus on higher value relationships, like with TurboTax Live, seems to apply to Credit Karma too. It's becoming a really key piece of their bigger consumer strategy, which leads right into the One Consumer Platform initiative. Effective August 1st, 2025, they combined Consumer, Credit Karma, and ProTax into just one single consumer segment. Seems like they're aiming for a totally unified customer journey. What are the upsides of pulling these traditionally separate things together under one roof, both for us consumers and for Intuit?
Yeah, the benefits could be really significant, potentially transformative. First, for the consumer, the goal is a much smoother, more holistic experience. Instead of thinking, okay, tax time is TurboTax, credit scores, Credit Karma, maybe budgeting somewhere else, it all becomes part of one platform you use year-round.
Like a financial dashboard for everything.
Kind of. Imagine applying for a loan on Credit Karma, and maybe your verified income data from TurboTax helps streamline the approval. Or getting personalized financial tips based on both your credit profile and your tax history, all in one trusted app. Second, for Intuit, this is all about driving continuous engagement, not just seeing you at tax time. More engagement means more data, right? More chances to offer relevant products, credit cards, loans, investment options, whatever fits your profile. From building credit to building wealth. It turns that seasonal tax relationship into an ongoing financial partnership, deepens loyalty, increases the lifetime value of each customer by serving way more of their financial needs under one consistent brand. It's a powerful move to capture more share of the consumer's financial life.
That's a huge shift, aiming for that year-round relationship. Okay, let's explore the Intuit Playbook. The power of customer obsession. We hear that phrase a lot, customer obsession. But the claim here is, for Intuit, it's like a real competitive advantage, not just a slogan. And it started really simply, almost ridiculously old school. Founder Scott Cook, way back when, literally picked up a phone book.
Physical phone book.
Yeah, and just started calling random small businesses. No sales pitch. Just asking, what are your biggest frustrations managing money?
And that basic listening. It's so critical. Lots of companies say they listen, but that origin story, it shows this deep, almost like anthropological desire to understand the unspoken struggles, not just react to feature requests. The key thing about Intuit's customer obsession, I think, isn't just listening. It's proactively finding and fixing those unvoiced pain points. That kind of approach builds products people can't imagine living without. Creates loyalty that's really hard for competitors to break. It's kind of a reminder, isn't it? Sometimes the best insights don't come from fancy algorithms, but just from genuinely listening to people complain. Many companies could probably still learn from that.
Totally. And the big insight from those calls, many small business owners didn't have accountants and just hated dealing with money stuff. So what did Intuit do? They built QuickBooks specifically for people who hated accounting. Boom, 85% market share in 4 years. They did the same with TurboTax, designed for the average person dreading tax season. Made it intuitive, confidence-boosting, no tax degree needed. Mint, remember Mint? Made budgeting automatic, visual, easy, turned a chore into something maybe less painful, even a habit. And even Mailchimp, like we talked about. Buying it is seen as predicting and solving marketing pain points before they become complaints, right? Folding it into that bigger platform.
That pattern across all their major products, that's what makes the customer obsession real. It's a repeatable playbook. They're not just ticking off feature requests. They're finding the underlying struggle, then building these habit-forming products around solving it. creates amazing stickiness. Their tools become less like software and more like essential partners in people's financial lives.
So if you boil down their strategic pillars, it sounds like, build around struggles, not just feature lists, create habit-forming stuff that's hard to quit, focus on keeping customers, maybe even more than finding new ones. Keep it simple. Don't overload with features nobody uses, and proactively disrupt themselves. Think QuickBooks Online replacing desktop, AI in tax, buying Mailchimp before someone else does. And this one's really interesting. Their goal is making finance invisible, not exciting. How revolutionary is that? To intentionally try to make finance disappear. What does that mean for the user, for their brand? And maybe, does that invisible approach ever risk making them seem less cool, less innovative compared to flashy fintech startups always trying to engage you?
That invisible finance idea, it is pretty revolutionary because it taps into something deep. Most people don't want to spend time and mental energy on boring, stressful money tasks.
Right, just make it go away.
Exactly. For most of us, finance isn't exciting. It's complex, maybe intimidating, definitely time-consuming. The genius here is Intuit realizing people don't want to engage with their finances. They just want their finances to work smoothly in the background. So Intuit's brand shifts from being just a tool you have to use to being this seamless enabler of, like, financial peace of mind. Their brand identity becomes less about being the shiniest new fintech and more about being the super reliable, trusted partner that just makes things easy. They want the tools to fade away, right? Working perfectly, managing money, doing taxes, sending marketing emails so you can focus on what you actually care about.
That builds huge loyalty.
Immense loyalty. Makes their products indispensable, almost subconscious. Builds trust through sheer reliability and effortlessness. While other brands are chasing engagement with maybe points or games or flashy charts, Intuit's aiming for relief and simplicity. It's counterintuitive, but it's exactly what a huge chunk of the market wants. And it really sets them apart. It's a remarkably insightful strategy, honestly, turning that pain into quiet efficiency.
Yeah, turning pain into a background hum. Great phrase.
Yeah.
Okay, moving on. Let's look at the financial outlook, capital allocation, and shareholder value. Balance sheet. As of July 31st, 2025, they've got about $4.6 billion in cash and investments. Debt's around $6.0 billion. But what really jumps out are these huge intangible numbers. Goodwill at almost $14 billion. Acquired intangibles net at $5.3 billion.
Wow, that's a lot of goodwill.
Right. Definitely points to those big acquisitions. How do numbers like these affect how analysts look at the company? What does it signal strategically?
Yeah, those huge intangible figures, especially the goodwill, are the direct result of buying Credit Karma, $7.01, and Mailchimp, $12. Goodwill is basically the premium you pay over the fair value of the tangible stuff you bought. Now, strategically, these buys are crucial for expanding their ecosystem, future growth, all that.
Sure.
But for analysts, large goodwill and intangibles get scrutinized. Why? Because they don't directly generate cash themselves. And there's always a risk they might have to write them down later in impairment charge if the acquired business doesn't perform as expected.
Which hurts earnings.
Exactly. And more immediately, these big numbers balloon invested capital, as one source put it. That can really weigh down metrics like return on invested capital, ROIC, which we'll touch on. So while management clearly sees huge long-term value, analysts have to factor in integration costs, potential write-downs, and the impact on near-term returns, even as Intuit builds that long-term value. It signals they're willing to invest super aggressively for strategic position and future growth, maybe sacrificing some near-term balance sheet cleanliness to do it.
Okay, clear trade-off there. Now, capital allocation, how are they using their cash? Seems like they're returning a lot to shareholders. They bought back $2.8 billion of stock in fiscal 25, and the board just approved another $3.2 billion for buybacks. That brings the total authorization up to $5.3 billion.
Very significant buyback program.
Yep. And they also upped the dividend. Approved a quarterly dividend of $1.20 per share, payable October 17th, 2025. That's a 15% increase year over year.
Both moves show a strong commitment to shareholder returns. Buybacks reduce the share count, potentially boosting EPS. And raising the dividend like that signals management's very confident about future cash flows, the sustainability of the business. It looks like a pretty balanced approach, returning cash while still clearly investing heavily for growth, both internally and through acquisitions.
Okay, looking ahead now, fiscal year 2026 guidance, ending July 31st, 2026. They're forecasting revenue between $20.997 billion and $21.186 billion. That's solid 12-13% growth. Operating income, GAAP expected to grow 17-19%, non-GAAP 14-15%, and diluted EPS GAAP projected 13-15% growth, non-GAAP 14-15% growth.
Wow, consistent double-digit growth guidance pretty much everywhere you look, plus continued margin expansion. That signals a lot of confidence from management and their strategy, their execution. That kind of predictability, steady growth, that's exactly what long-term investors often look for in a quality compounder, isn't it?
Seems like it. And drilling down into segments for FY26, GBS expected to grow 14-15%, or 16.5% if you exclude Mailchimp again, the new combined consumer segment. 8-9% growth projected. That breaks down to TurboTax at 8%, Credit Karma 10-13%, and ProTax 2-3%.
Interesting seeing Credit Karma guided higher than TurboTax
Yes.
there.
And for Q1 of FY26, ending October 31st, 2025, they're guiding revenue growth around 14-15%, GAAP EPS $1.19 to $1.26, non-GAAP EPS $3.05 to $3.12. So this steady double-digit guidance, margin expansion, feels like they're pretty optimistic. What's really driving that confidence, and are there any potential bumps in the road that could challenge these forecasts?
Well, the optimism seems rooted in, I'd say, three main things working together. First, that AI-driven expert platform strategy is clearly working. TurboTax Live's success, bringing AI agents into the mid-market IES, shows they can innovate and scale up premium services, move customers to higher value tiers.
Right, the mix shift again.
Second, that aggressive push into the mid-market. It's unlocking this huge new potential customer base, and that all-in-one platform message seems to be landing well with businesses fed up with juggling too many apps. And third, the synergies within the ecosystem just keep getting stronger. Credit Karma feeding into TurboTax, the whole one consumer platform idea driving year-round engagement and spending. These things together create multiple paths for sustained profitable growth, potential bumps. Well, Mailchimp integration is still ongoing, right? Long-term vision's clear, but execution always has risks.
Sure.
Competition in the mid-market could heat up more than they expect from established players or maybe nimble fintechs. And while strategically letting lower ARPR tax filers go makes sense for profit, they do need to keep innovating and proving value to those higher ARPR customers to keep winning share there. They can't take that segment for granted.
Okay, now for a different lens entirely. Investment readiness, Intuit versus new holdings. A comparative look. We're using something called an investment readiness score, or IRS. It's basically a composite metric, rolls up things like debt, cash generation, profit, growth consistency into one score to quickly gauge a company's overall health and potential. Anything above 80% usually flags it as strong, worth a deeper look. Intuit's IRS comes in at 78.3%. Good, solid, but just shy of that 80 mark. Let's look at the strengths first. What gets it that high score? Net debt to EBITDA, 0.6. That's excellent. Scores 95.8 out of 100. For software, that low debt relative to earnings shows huge financial flexibility even after those big buys.
Absolutely. Very healthy financial cushion there. Tons of cash flow relative to debt.
CapEx to sales, just 0.66%. Super efficient asset-light model. Scores 97.4. Typical for high-margin software, shows they run lean. Operating cash flow to net income, 160%. Perfect 100 score. Means they generate way more cash than their accounting profit shows. High-quality earnings sign.
That's a great metric to see.
Gross margin, 80.76%. Premium software margin scores 93.6. Net profit margin, 20.55%. Strong profitability, 82.2 score. And consistent growth. Revenue 10-year compound annual growth rate, CAGR, is 18.55%. Scores 89. Fantastic for a company this size.
Yeah, I mean, those metrics together, they paint a picture of a really high-quality, mature, cash-generating machine operates incredibly efficiently, especially given its scale.
So with all that going for it, what pulled the score down just below 80? Well, intangibles to assets ratio, 52.17%. That gets a lower score, 50.4 out of 100. High because of Credit Karma, Mailchimp. Balance sheet loaded with intangibles, which, like we said, analysts watch closely for impairment risk, and they don't generate cash directly. Also, return on invested capital, ROIC, 14.82%, score 79. And this has actually dropped quite a bit from around 35% back in 2019.
Wow, big drop.
Yeah, blame the integration costs and all that goodwill from the acquisition's ballooning invested capital. It's lower, but maybe it's a strategic trade-off again, right? Accepting lower near-term capital efficiency for hopefully bigger long-term market share and value. It's definitely a key debate for investors.
Really highlights the impact of those big strategic buys. They expand the ecosystem, the long-term potential, sure, but they definitely hit those near-term efficiency metrics like ROIC and inflate the intangible assets. It's that classic trade-off, immediate financial efficiency versus long-term strategic position. And it's a big reason why their IRS, while good, isn't quite hitting that excellent tier.
And the last couple things. Stock-based compensation to revenue, 10.45%, gets a lower score of 50.9. Noted as elevated, which is pretty common in tech, using stock to get and keep talent.
Hmm.
And ownership management, 2.30%, also scored lower compared to new holdings, suggesting maybe less direct skin in the game for insiders compared to some others.
Yeah, the stock-based comp, it's always a factor in tech. It's non-cash, but it does dilute shareholders over time, so you watch it.
Hmm.
And lower insider ownership just means management's personal wealth is maybe less directly tied to the stock price going up compared to founders or companies with really high insider stakes.
Okay, now the comparison. New Holdings, or New Bank, the disruptive digital bank, mostly in Latin America, their IRS, 90.3%. Superior score, highlights for Newmar. Hypergrowth, 82.55%, 10-year revenue, CAGR. Pristine balance sheet, net debt EBITDA is negative 4.4. They literally have way more cash than debt.
Wow, negative debts.
Minimal goodwill and tangible assets, only 1.53%.
Mhm.
Shows they grew organically, not through huge buys. And huge insider alignment ownership management at 22.03%.
Yeah, New Holdings is clearly a different beast, different stage, different market. That hyper-growth, clean balance sheet reflects that agile, organic expansion in emerging markets. They don't have billions in goodwill from acquisitions dragging on metrics like Intuit does. Makes for a really interesting contrast in investment profiles, doesn't it? Different ways to win.
It really does. Okay, let's ground this with a market reality check using free cash flow yield, FCF yield. Comparing it to the 10-year U.S. Treasury, which is around a 4.23% right now. For Intuit, the FCF yield is about 3.27%. Why does it matter that this is below the Treasury yield?
Okay, this is a really important valuation signal. When a company's free cash flow yield, basically the cash return you get for each dollar invested in the stock, is lower than what you can get risk-free from a treasury bond. It strongly suggests the stock might be fully valued, maybe even a bit expensive, if you're just looking at its current cash generation versus its price.
So you're paying a premium.
Exactly. Investors buying into it at this yield are paying a premium for its stability, its quality, its market dominance, its consistent growth prospects, even if that growth isn't explosive. They're accepting a lower immediate cash return today because they expect future growth will justify the price, or they just value the predictability and lower risk of a market leader. It implies the market has already priced in high expectations.
Okay, whereas New Holdings, their FCF yield is around 5.7% based on TTM FCF share of $0.78. That's comfortably above the Treasury yield.
Right, and this is where that source talked about asymmetry and high upside opportunities. Nuda's FCF yield being well above the risk-free rate, despite its incredible growth and its position in emerging fintech. That suggests it might actually be undervalued relative to its potential and its cash generation.
So potentially more room to run.
Potentially. It indicates more attractive valuation for investors looking for long-term growth and maybe offers a better margin of safety. Finding that kind of hypergrowth combined with an attractive FCF yield is relatively rare. That's why it gets flagged as a potential high upside play.
So the verdict from that source, comparing them, New Holdings comes out ahead for long-term investors seeking those high upside opportunities. Because of the higher IRS, the crazy growth, cleaner balance sheet, better FCF yield. This comparison is really fascinating. The aha here isn't just faster growth is better. It's understanding that life cycle difference, right? How a leaner, hyper-growth disruptor like New offers a totally different risk reward than an established acquisition-heavy giant like Intuit, even if both are leaders. So does Intuit's stability make it safer? Or does New's growth and valuation point to a different kind of opportunity altogether?
It really highlights two totally different investment styles, doesn't it? And neither is automatically better. They just suit different people.
Yeah.
Intuit is your classic, mature, high-quality compounder, kind of a safe harbor maybe, sticky ecosystem, consistent, moderate growth. You're buying proven dominance, strong cash flow, predictable returns, but yeah, you pay a premium valuation for it. New Holdings. That's the promise of exponential growth in a huge emerging market, plus a more appealing valuation based on current cash flow. It's higher risk, sure, but potentially much higher reward. An opportunity for serious capital appreciation if they keep executing and navigate that market well. So, Intuit offers stability, predictable compounding. New offers that asymmetry, the potential for explosive upside, if you can handle more growth volatility.
A great way to frame it for investors thinking about their own risk tolerance. Okay, finally, let's look at navigating the market, a trader's and investor's view on Intuit, INTUS. So the stock popped over 8% after that recent Q3 report we implicitly discussed earlier based on the source date, trading around $720.13. Called it a monster Q3 great tax season. Credit Karma bouncing back, strong momentum in assisted tax.
Yeah, that kind of jump after earnings. Clear sign the results beat expectations by a lot.
Hmm.
Markets definitely feeling confident about where they are and where they're headed right now. It's strong validation.
Looking at the chart signals, technically things look bullish. Price action and volume. A clean breakout above old resistance around $690. Closed strong near $720 on really high volume, highest since February, apparently. Indicates real buying pressure, real conviction.
High volume on a breakout is key. Shows
Done.
participation.
Moving averages. The 20-day, 50-day, 200-day, simple moving averages, SMAs, all lined up in classic bullish order, short above, medium above, long and rising. Textbook signal of strong upward momentum, healthy trend. RSI, Relative Strength Index, up at 76. That's technically overbought, means it moved up fast.
Which can sometimes mean a pullback is due.
Right, but the take here is, in a fresh breakout like this, it often just means momentum is strong, and breakouts often ride the overbought zone for a while. MACD, another momentum indicator, widening upwards after a bullish signal, shows momentum building. And IV rank, implied volatility, around 53, kind of middle of the road, suggests options aren't crazy expensive, market isn't pricing in huge fear of a big drop.
Yeah, those are all pretty textbook technical signs of a strong uptrend kicking off or continuing. The breakout on volume, the moving average is lining up perfectly, momentum building, suggests the market digested that good news and is betting on more upside. Even the overbought RSI, in the context of that breakout, points more towards sustained buying than just a quick spike.
Okay, so for short-term traders, the advice was actually not just yet. Avoid chasing it right after that big jump. Suggested waiting for a small pullback or a consolidation, maybe into the $711, $714 zone, see if that holds as new support. Enter if it bounces from there on volume. Stop loss suggestion, close below $689. Targets, $734 first, then maybe $755 plus if momentum carries. Now, for long-term investors, advice was different. Scale into a position. Don't go all in at once. Maybe start with some shares now, add more if it pulls back into the mid $700 or even low 690. So that's the tactical view. How do these short-term chart signals really mesh with the long-term fundamental story we've been talking about?
They actually align really well. The technical breakout is basically the market confirming that strong fundamental story we discussed. It's recognizing the value of that consistent revenue, the recurring income, being insulated from tariffs, Credit Karma's comeback, the dominance in tax and small business, all now getting supercharged by AI.
So the charts are reflecting the fundamentals.
Exactly. The short-term technical strength is the market giving a big thumbs up to that fundamental quality and the strategic direction. And the advice to scale in for long-term folks. That's just prudent portfolio management. Acknowledges the quality, but advises caution after a big run-up. Don't chase, maybe average in at potentially better prices, but stay invested in the overall upward trend driven by those strong fundamentals. It's a practical way to handle a great company that just put up great numbers.
Okay, that brings us towards the end of our deep dive on Intuit. We've covered a lot of ground, right? From that foundational customer obsession
The phone bookstore.
into their really impressive fiscal 25 results, that strategic pivot towards AI, the big move into the mid-market. We've seen how their consistency, their cash generation mark them as a really high-quality company, even while we acknowledge how those big acquisitions impact metrics like ROIC and load up the balance sheet with intangibles. Whether you're just interested in fintech, maybe you run your own small business using their tools, or you're just curious about what makes a market leader tick. Intuit's story has a lot of insights, doesn't it? How innovation, smart acquisitions, and really listening to customers can build lasting success. That whole idea of making finance invisible really speaks to their unique brand and how they think about value. So Intuit's clearly shown it can adapt, grow, use AI to redefine things. But as that new holdings comparison showed, the investment world keeps changing. Different opportunities, different stages. Looking ahead now, given Intuit's huge AI bets that push into the mid-market, that commitment to invisible finance, what part of their strategy do you think will be the absolute most critical for keeping their growth and leadership going over the next, say, 5 or 10 years? And maybe what's the biggest question Intuit still needs to answer to really lock down its future against both those nimble startups and the big entrenched enterprise players?